Have you ever wondered how stock prices can fluctuate so wildly, detached from company fundamentals? Do you suspect shady manipulators may artificially rig securities behind the scenes? If so, you're onto something big and have come to the right place. We've all seen those dramatic movie scenes where traders are frantically buying and selling stocks, trying to manipulate the market for their own gain. But does market manipulation really happen in the real world? Unfortunately, yes. It's an illegal yet common tactic used to artificially inflate or deflate stock prices. In this video, we'll provide the only explanation of stock market manipulation you'll need. We'll start by defining exactly what manipulation is. Then we'll discuss why people choose to manipulate stock prices and the main techniques they use to do it. Finally, we'll talk about how authorities try to detect and prevent manipulation to protect regular investors. By the end, you'll understand all the ins and outs of this risky trading strategy. Stick with us to uncover the truth about those chaotic trading flaws you see in the movies. Manipulation may be thrilling on screen, but in reality, it harms innocent people and distorts economic stability. So, what exactly is stock market manipulation? First, let's clarify exactly what stock market manipulation entails. At its core, it involves deliberately influencing stock prices through deceptive and unfair tactics. The goal is for manipulators to profit at the expense of regular investors who get tricked into making losing trades. Specific manipulation strategies artificially inflate the price of stocks the manipulator owns through hype and misinformation. Other tactics artificially lower prices through pessimistic rumors so stocks can be purchased cheaply. In both cases, legitimate supply and demand forces in the marketplace get distorted and stock prices get detached from companies' fundamental values. It's critical to note that minor nudges or fluctuations in share prices based on normal trading don't qualify as manipulation. Natural corrections and reactions are expected daily in financial markets. True manipulation requires intentional, non-transparent deception that severely impairs how stocks are valued. Regulators view market manipulation as extremely unethical and damaging. When proven, perpetrators face major fines or even jail time. However, detection is challenging in busy, chaotic trading environments, and new technologies like AI and social media allow for manipulation at unprecedented speeds and scales. Authorities must stay vigilant to protect everyday citizens from schemers looking to profit through lies and deceit. Now that we understand manipulation better, a logical question emerges. Why would anyone choose to manipulate markets given the risks involved? Unfortunately, while morally questionable, manipulation offers traders potential rewards that incentivize cheating the system, including sky-high profits. Successfully manipulating a stock price in your favor lets you make a killing buying low or selling high. Even a small price distortion magnified across millions of shares results in massive fraudulent gains. The promise of bags of cash causes some to abandon ethics. Thrills and prestige. Traders who get away with complex manipulation schemes gain prestige and notoriety among colleagues. Outsmarting authorities provides an adrenaline rush and inflated ego. The psyche of certain personalities craves the risks, excitement, and status. Desperation and greed. For struggling fund managers facing redemptions or trading firms at risk of insolvency, manipulation presents a tempting shortcut to regain stability. When livelihoods are at stake, normally upstanding professionals cross ethical boundaries out of desperation and greed. Overall, the potential payouts from market manipulation are simply too lucrative for certain traders to resist, and those overseeing trading activities don't always sufficiently root out bad behaviors that subordinate integrity to profits. It's a perfect storm enabling manipulation to persist despite increased regulatory scrutiny. Until incentives change or penalties heighten substantially, stock manipulators will likely keep scheming indefinitely. Now that we see why manipulation appeals to certain traders, let's explore the most common techniques they employ to distort stock prices. Pump and dumps. The classic approach pumps a stock price through false hype before dumping shares to unsuspecting buyers. Manipulators spread exaggerated purchase rumors, fake news, misleading projections, or volume spikes to spark a rally. As prices peak, insiders sell quietly, leaving victims with worthless shares. Short squeezes. This reverses a pump and dump by targeting heavily shorted stocks. Short selling is when investors borrow shares to sell them, hoping to buy them back later at lower prices in order to profit from the price decrease. Manipulators aggressively purchase shares and option calls. options giving them the right to buy shares at a predetermined price to create a spike in the share price, aiming to trigger stop losses, forcing short sellers to cover or buy back their shorted positions to limit losses. By the time prices normalize, manipulators have already locked profits from the squeeze. High-frequency spoofing. Modern electronic platforms allow placing spoof orders, fake orders that are cancelled before execution, for stocks that trick algorithms into reacting, sparking a short-term price swing. Sophisticated software lets traders spoof at blink of an eye speeds across asset classes. Social media schemes. Online pump groups frequently appear promoting obscure stocks using fake accounts, bots, and paid endorsements. They attract uniformed retail traders, whip them into an emotional frenzy about the stock, then the organizers sell out their positions, crashing the stock price and tricking the members who joined the pump group into losing money. Some groups charge monthly fees, raking in cash while deceiving members into losing money on the stocks they promote. These techniques just scratch the surface of known manipulation plays. As technology progresses and markets expand, so too do the tactics unscrupulous traders wield. To limit the fallout, regulators must allocate proper resources to uncover novel schemes, tracing their arcane digital footprints across our hyper-connected world. Only through vigilance and cooperation across global financial authorities can market integrity sustain itself over the long run. Catching stock market manipulators represents an immense challenge for regulators. However, they employ a multi-pronged approach, combining human financial insight with cutting-edge AI surveillance technology to try reining in stock cheats. Specialized teams pore over intricate trading data, seeking to uncover subtle suspicious patterns. What are some of the red flags they look for? For one, sudden and extreme price or volume spikes could signal someone is artificially pumping up a stock before dumping their shares. Strange activity detected around options linked to certain equities might indicate manipulators trying to disguise large share positions. Detecting accounts or IP addresses coordinating questionable buy-sell orders could expose an organized scheme spreading across individuals or firms. Carefully tracking asset transfers between bank accounts could spotlight colluding parties potentially engaged in deception. Other warning signs involve unusual market-moving tips, rumors, or hype fueling irrational stock exuberance or despair. Authorities even screen for known past offenders who try to evade authorities by returning under new names or entities. But could overworked regulators realistically connect these dots across oceans of complex trading activity on their own? This is why sophisticated software complements human sleuthing efforts by rapidly analyzing immense volumes of trade evidence with untiring stamina. Complex algorithms model baseline price dynamics for stocks, quantifying abnormalities statistically no matter how deeply buried. Mathematical models identify outlier trades that then undergo stringent auditing, with regulators backtesting assumptions to eliminate false positives. Authorities also leverage sentiment analysis AI that screens content across social media platforms and message boards with unblinking precision. Subtle word choices, contexts, and metadata help algorithms pinpoint organized campaigns to pump or bash specific stocks. This expands regulators' detection net significantly amidst the new Wild West frontiers of Web 3.0, where manipulation campaigns germinate. Despite such commendable efforts, however, enforcement remains a slippery cat-and-mouse game, as manipulators constantly tweak sneaky approaches to evade authorities. Could regulators ever truly checkmate cunning market schemers when technological innovation shifts the playing field every year? Like cybersecurity experts chasing invisible hackers, financial authorities must constantly upskill human workforces while upgrading AI-powered toolsets to keep pace with the sophisticated manipulators undermining equitable markets. For now, the tireless battle against market manipulation seems destined to persist as long as financial incentives and lax penalties enable unethical traders to justify illegal risks. And there you have it, a comprehensive rundown of what stock market manipulation entails and why it keeps occurring despite downsides for overall economic stability and fairness. While the term may conjure up thrilling images of shouting traders and frantic trading pits, the real-world impacts of manipulation are far more insidious. In reality, market manipulation erodes public trust in financial systems meant to support healthy capital flows and commerce. When unchecked, these schemes redistribute money unethically from retail investors into manipulators' pockets. Over time, the collateral damage compounds through lost output, talent misallocation, business closures, and distorted readings of fundamental asset values. Fortunately, regulators seem to grasp manipulation's gravity and allocate growing resources to combat it. Detection technology and multilateral cooperation agreements offer promising countermeasures against those corrupting financial markets. However, staying a step ahead requires ever more vigilance as new digital tools afford manipulators greater reach and anonymity. For everyday investors, skepticism remains the best self-defense when wild rumors or inexplicable price moves emerge. Avoiding emotional knee-jerk reactions lets individuals bypass manipulation traps awaiting the unwary. Building diverse portfolios via index funds also helps smooth volatility sparked by manipulative schemes affecting individual stocks. Well, that's all for today. We hope this explanation gave you new insight into market manipulation, both its real-world impacts and why it continues beguiling certain traders. While eradicating schemes completely poses challenges, maintaining equitable and transparent markets that promote economic prosperity remains central to policymakers and regulators' missions. Across global financial centers, the regulatory watchdogs refuse to sleep, working tirelessly to protect capital market integrity.